Hidden Systems uncovers how the rich avoid taxes, not illegally but structurally. Hidden Systems explains the invisible systems that quietly shape money, power, and everyday life. Subscribe to stay informed about the systems that you live in, but quietly unaware of. Most rich people don't cheat on taxes. They follow the rules. The problem is the rules weren't written for you. This is how the system actually works. Hidden Systems: how the rich avoid taxes. Law incentives design. The big misconception. When people hear tax avoidance, they imagine hidden cash, secret accounts, or outright fraud. That's not how most wealthy individuals operate. Tax evasion is illegal. Tax avoidance is legal. And the modern tax system is built to allow it. Why? Because tax codes are not designed around wages. They're designed around assets, ownership, and investment. If your income comes from a paycheck, taxes are simple and automatic. If your income comes from capital, taxes become optional, conditional, and negotiable. The system does not tax wealth. It taxes events. And the wealthy are very good at avoiding taxable events. The difference between income and wealth. The most important distinction in the tax system is this: income is taxed. Wealth is not until it's realized. Wages are realized immediately. They are visible. They are easy to tax. But wealth usually exists as assets: stocks, businesses, real estate, intellectual property. As long as those assets are not sold, there is no taxable income. A billionaire can become richer every year on paper, without triggering a tax bill. This is why you'll often hear headlines like, "Billionaires paid lower tax rates than teachers," not because they broke the law, but because most of their wealth never became taxable income. Buy, borrow, die. The core strategy used by the wealthy is often summarized in 3 words: buy, borrow, die. First, buy assets. Assets appreciate over time: stocks, companies, property. Second, borrow against those assets. Instead of selling stock and paying capital gains tax, wealthy individuals take out loans using assets as collateral. Loans are not income. They are not taxed. The borrowed money is then used for living expenses, investments, purchases. Third, die. At death, many tax systems reset the cost basis of assets. This means heirs inherit assets, as if they were purchased at current market value. The capital gains tax? Often erased. The wealth transfers intact. The tax liability disappears. This is not a loophole. It is standard law. Capital gains versus wages. Even when the wealthy do realize income, it's often taxed differently. Capital gains profits from selling. Assets are usually taxed at lower rates than wages. Why? The justification is that capital gains encourage investment and economic growth. But the effect is simple. Workers pay higher effective tax rates than investors. The more your income comes from capital, the less you pay. This creates a structural divide. Labor is taxed aggressively. Ownership is taxed gently. The system rewards having money, not making money. Businesses, deductions, and structuring. The wealthy rarely earn income as individuals. They earn through entities, corporations, partnerships, trusts, holding companies. This allows income to be classified, deferred, or offset. Business expenses reduce taxable income. Depreciation allows assets to lose value on paper even as they rise in reality. Losses in one area can offset gains in another. A profitable company can show minimal taxable income without losing real cash. This isn't fraud, it's accounting design. Tax codes are full of incentives meant to shape behavior, investment, hiring, development. Those who can afford experts know how to use them. Offshore, but not illegal. Offshore does not automatically mean illegal. Many wealthy individuals and corporations use low-tax jurisdictions to structure ownership. Profits are booked where taxes are lowest. Intellectual property is held where rates are favorable. Revenue is shifted through transfer pricing and licensing. The money often remains within the legal system, just outside high-tax borders. The result? Profits exist everywhere. Taxes exist nowhere. Again, this is not primarily about hiding money. It's about choosing where money exists on paper. Why the system allows this? So why does the system permit this? Because capital is mobile, and governments compete for it. High taxes on capital risk, capital flight, reduced investment, market instability. So tax systems are written to be flexible at the top and rigid at the bottom. Wage earners cannot move their income. Capital can. This creates leverage. The wealthy don't need to break the rules. They influence how the rules are written, not always through corruption, but through incentives, lobbying, and economic pressure. The system optimizes for stability, not fairness. Who pays instead? When wealth is lightly taxed, the burden shifts. 2. Labor taxes, consumption taxes, payroll taxes, fees and fines. These are harder to avoid and easier to collect. The system becomes regressive by design. Those with the least flexibility pay the most reliably, not because they're targeted, but because they can't escape. The bigger picture. This is not a story about villains. It's a story about structure. The tax system reflects what the economy values: ownership over labor, stability over redistribution, capital mobility over voter preferences. As long as wealth remains untaxed until realized, and capital remains more mobile than people, this pattern will persist. Elections may adjust rates. They rarely change architecture. The rich don't avoid taxes by breaking the law. They avoid them by understanding the system better than most people ever will. At Hidden Systems, we don't expose people. We explain systems. Subscribe to stay informed about the systems you live in.